Righto, welcome to the blog. What I want to do here is just spend a little bit of time and do a bit of a session on focusing on exit strategies. It's sort of an area, or definitely is an area of trading that's really underdone. It certainly took me a little bit of a while to come across this sort of information. And in the retail world, there tends to be a lot more of a focus on entries just because it's sort of the area that people want to hear about. But when you look at it and really break it down and look at professional traders are doing. And when I say professional traders, I mean anyone that's been around a bit of a time, been around a while, put some time and effort into it, and they managed to turn it into a business that's creating positive cash flow. Many people come and go in the trading industry. It's like any businesses or any sort of area like this. It's sort of people have got to it's easy to get into and it's certainly easy to get out of trading. But if you spend some time and effort on it, certainly you'll start to, we need to start focusing on sort of what we're going to want to talk about here, and that's exits. And it's important to spend as much time, if not more time, on exit strategies and management of the trades as the entry of trading systems. What I'd say with this to start off with is find some good literature on exits. With anything in regards to trading, always go out there and develop it and find the information for yourselves and really base it on something that you've found. I really like to break things down and be able to understand it for myself and not necessarily just rely on what someone else is saying. So once you dig deep, there's certainly some fantastic information out there. So just find some really good sources of information that you can sort of build on and really develop your knowledge around this area. I think with exit strategies too, when you look at professional traders, and a lot of them talk about having a couple of exit strategies. So right, like you do with your entries, you have a couple of different ways of getting to the market. You might have anywhere from two to four to even six entry signals. So it's important to, I'm not talking about multiple exits as in within the one trade. I'm talking about a couple of strategies designed to get you out of the market. So you're in a trade, you go, okay, if I can't get out this way, I get out this way. And there needs to be multiple ways to get out of the market, and that real focus on exits like you do with entries and really developing it, and rather just having some sort of just one system fits all for an exit. You really need to take it and develop it and go a little bit more further with it. And like I said, I'll make the point again, it's really need to focus on it and develop it. I know, and it's normal for traders to sort of, this is an area that sort of gets left behind. But when it becomes, common knowledge, or when you start to understand that exits is a massive part of becoming profitable, of course, then you really need to focus on it, develop it, spend time on it. And like I said, as much time, or if not more time, that there's this perception out there that they need to spend more time on it than entries, because it's at the end of the day, it's really what makes a trader profitable. And when you look at your trading plans, and you've got all your entry strategies written out, you need to have a whole section again that's purely focused on creating and developing exit strategies. And when you think about it, profit, trading, expectancy. We talk about expectancy as far as what your average winners versus average losers and strike rate and all that sort of things. It all comes back to exits, okay, and how a person manages a trade. And once you sort of get that in your mind and really start to focus on it, it's then a great place to start moving forward from. For me personally, I found it was a really quite a good feeling to know that everything's not just based on the entry now. That I don't have to be sort of this U-Butte trader that can read the market really well and pick the perfect entry all the time. It's quite calming to realise that as long as I'm being consistent with the entry and I've got a consistent system, then as long as I go away and create a management program and exit strategy based on actual data, it's not necessarily based on who's got the the biggest brain or something to be able to create the best exits. It's all about just taking the information, running with it, developing it, and creating an exit strategy so you know exactly how to get out of the market. And once you start going ahead and doing these sort of things, it's a great feeling, and it's a really good place to trade from. When you're creating an exit strategy, it needs to be the same as you know, what we talked about with entries. It needs to be something that suits your personality. It needs to make logical sense to you. When you sit back and look at it, it goes, yep, that makes sense. That's a great way to get out. You really need to think about your trading objectives too. Everyone trades and has different objectives, so think about your trading objectives. That's that's the first place to start off with a trading plan, and then with your trading objectives, that's where you start basing entries, and then of course you base exits on that as well. So think about what you want to achieve. Keep it very simple. I think simple is always best, but of course, like we say with entry systems, it needs to be very systematic. You need to have a very definite plan where you're not deciding each individual trade what you're going to do here. It's already predetermined. You go, okay, well this has happened. Well then it's this sort of exit strategy, and I'll give you a bit of an example of what I mean by that. But it needs to be systematic, already developed, and then basically as the markets play out, you know exactly what to do in regards to your exit strategy. And it's important then to be doing the same thing over and over again, and that's what develops fantastic habits and really good belief. If you can take that system and it almost like the back of your hand, and it's just a matter of just going through the procedure because it's very clearly stated and you've done it before. As far as creating something that suits your objectives, for me, my objective as far as when I look at trading is to keep my risk down. Okay, I'm not someone that's prepared to go through massive drawdown. People that have that really want massive returns and prepared to got quite a bit to give back. Maybe that they're prepared to give a bit more risk. For me, I'm developed as I move along as a trader. I'm getting reducing risk more and more. So I want to keep a situation where risk is certainly down, but I want my winning trades to be at least 2 times the size of my losers. So I'm keeping risk down, but I'm very much in the mindset of having a situation where every trade I take, I'm pretty much in a situation where I'm always going to create my winners are always going to be twice as big as my losers. For me that's a great place to trade from. That's how I feel comfortable trading. So for me then I need to go away, and I created a 3-tier approach or a three strategy approach for exits. And before I kind of get into it and talk a little bit more about what I do, for me, I had a couple of respected opinions that impact my decisions, and and these opinions are quite different as well. So it's important to go when you're out there reading information, you will find quite conflicting opinions. So it's important to take sort of the best of it and mesh it and mold it to suit you, and it comes back to your personality. So I've got sort of one side of me is trading the zone. A lot of us appreciate trading in the zone. Mark Douglas talks about some fantastic stuff there, and he talks a lot about having multiple exits or profit targets within the one trade. For example, get some contracts out here, get some contracts out here, and then some here. So I've got sort of that as an influence going, okay, give myself a chance to just let the trade keep on going if it needs to. But then I've sort of got another side. I've got a couple of other people that influence my decisions, Van Tharp and a few other traders that are sort of from his model, where they say, with risk modeling and expectancy, it's all about your average winners and your average losers. And when you exit a trade, so for example, if it was to go straight to a stop and it doesn't go in your favor, what's going to happen is you're going to exit all your contracts at your maximum stop loss. So for that reason, he says, if you're getting contracts out in profitable situations, partly along the way, as your profit gets bigger and bigger, or as the trade moves more and more in your favor, you've got less and less contracts working for you. So he's sort of the opinion that you really shouldn't have multiple exit strategies, and that you should really just let all your contracts go to a certain point. So that's what I mean. I've got 2 quite influential opinions, and 2 guys that I base a lot of my trading on. Yet the guys are saying 2 different things as far as exit strategy. So from that, I've just taken sort of the best of both worlds and found a way to make it work for me, and I'll explain in a second how I've managed to mesh the 2 of them into a strategy that works for me. But like I said, ultimately it comes back to what suits you, and thinking about, okay, how would I interpret that information, and also what's going to create the most profit for you. So I took these 2 ideas and said, okay, well, let's collect the data and see from this previous data, what's the best thing for me to do. And I really suggest, recording all all data, record as much information as possible. I have a spreadsheet, quite a detailed spreadsheet, where I'm just recording everything from it, and even information I don't necessarily need at this stage now, but I want that information available to me. So in the future, if I need to go back and do something, I can go back over previous spreadsheets and databases and be able to take that information and create a model or create a management system that's going to work for me. So I'm always collecting information and as much as possible. And then you take that information, and based on your specific trading areas and what the market's doing in the way that you trade it, you can then create a system or a style that's suitable to yourself. And then for me, in regards to these two opinions that I talked about earlier, what I found from recording months and months of data, and obviously the more the better, I found that in certain circumstances, what I want to do is take profit at 1R, or what I mean is, if I'm risking 5 ticks, I want to take some profit out as soon as it goes 5 ticks in my favor, in certain circumstances. But at the same time, I didn't want to limit myself to taking contracts out earlier. When I'm in a fast-moving, powerful full trend like that, and I'm going to restrict, like I said before, if I've taken some contracts out at 5 ticks, and all of a sudden, I'd get a 10 tick trade, 20 tick trade, all of a sudden I've got a whole lot less contracts working for me from that, say, 5 tick to 20 tick stage. Well, then profitability goes down quite a bit. So I'm looking at both those areas, I'm recording those both areas, and I'm finding something that's going to fit for myself and my personality, my trading technique. And some of my trading areas, like for example, I've got a directional trade. Directional trade is probably one of my biggest R trades, or one that I have most potential for to really go. Some of them potential to go 3, 4, 5 points. And I'll bring up an example of one in a sec. But if I pulled out a third of my contracts at 5 ticks, then I'm leaving a lot behind. So this is why it's important to have a specific exit strategy, so you know what to do, when to do it, and in the different circumstances. I want to know when, and systematically, when should I take contracts out at 5 ticks, and when should I have just let them go and really look for big R trades, or big return on my trades. And that's where a really defined systematic exit strategy comes into play. So just quickly, just as a bit of a, I don't want to get too much into the theory. I'll leave this for people to really find their own sort of theory, foundation or base. But this is kind of important just in relation to when I start talking about my exit strategy. But see it as there's four potentially different types of exits. Okay, a maximum risk exit. So we have a predetermined risk that you're not prepared to go past. Exits that produce a loss but reduce your initial risk. So that's where you're bringing stops out at different levels. And I'll give examples of all these soon. Exits that maximize your profits. So obviously where you're just looking to get some big R trades. And then exits that keep you from giving away too much. So there's always a balance between going for more, but also not all of a sudden having all this profit and you're just really going for it, then all of a sudden it comes right back against you, and you leave a lot of profit on the table. So there's certainly a balance between that third and fourth, and that sort of, I think, having a systematic approach and sort of really knowing beforehand what you do in regards to this area is quite important, because it can I guess it can get confusing if you are looking to go for more profit, but you sort of got this, you're not sure whether you want to take the profit that's already there for you, or whether you're prepared to let it run a bit and go for some bigger profits. So it's important to really understand and distinguish between the two of them. And then as far as just a couple of ways to exit trades, and this is again where you got to find something that suits yourself. There's all sorts of different stops. There's timed stops, which, for example, you might have a certain trade and you think it just should be going in your direction and going straight away. If all of a sudden it just kind of stalls and sits there, doesn't go against you or doesn't go with you, you might be prepared to just say, okay, I want to exit because I base myself on timed stops or dollar stops. Once it goes a certain distance, a certain profit, you get it out. Trailing stops. So, for example, where it might come back. Anytime it comes back a point, you stop. You trail by a point, or you trail by a percentage. Once it comes back 25% of the profit, some sort of predetermined trailing stop, or even sometimes people use Williams and moving averages and things like that. When it starts to cross back, that triggers their trailing stop. That also comes into play. Volatility stops. So when certain price action increases or decreases, and retracement stops. That's a bit like trailing stops, where it comes back a certain percentage, and you're just prepared to say, okay, if it comes back a certain amount, I'll take my profit there. For me specifically, I use predetermined profit or profit targets. So and this is for when I don't want to give. So when I'm talking about strategy number 4 here, where I don't want to give too much away. So for certain areas of the market, I've got predetermined. Just take it out once it reaches a certain level. As far as exit strategies, and then I've got another part of it where I'm using support and resistance targets. So where I'm looking to maximize profits, and I'll get into how I distinguish between deciding on these two different areas. But where I'm looking for more profit, I'm not prepared to just go at a certain predetermined level. I'm setting it to go towards a bigger target than that, and that's based on support and resistance. So looking for more profit, I'm basing on support and resistance. I'm not looking to give too much away. I've just got a very much predetermined level. It's not based on support or resistance. It's just a pure tick level or a pure dollar level. They'll just go, okay, it goes here. I'm getting everything out. Okay, but then I have ways of distinguishing between which is which. So when do I go for just a predetermined target, and when do I go for more, which I'll start to get into in a sec. So if exits are so important, and the pros say it's probably more important than entries. Think about how long you've spent on focusing on entries, and if you haven't put any time into your exits yet, because a lot of people tend to focus on the entries, which is quite normal when you start off in trading. I know it's certainly the case for me. Think about what you've done with the entry so far, and think about what you could do with exits, and do two things. Number one is sort of let go of the importance of entries. I'm not saying get slack by any means, but for me, I had to let go of the fact that entries was not everything, and really from then switch some focus to exits. So I don't want to take anything away from entries. Of course, that's got to be important. You've got to have something that suits you, but let go of the fact that it's everything in trading, which it's not. Exits have got to become a priority. And two is create a specific plan for the back end of your trade. So have a specific exit plan, and like your entries, sort of get out there, test it, read it, find the information, and really create something that suits yourself. Okay, so as far as a bit of a breakdown of what I've done in regards to this, let me just slide down here. Oh, one sec. Okay, so what I do. So keeping in mind before the four areas of exits where you need a specific maximum exit, you need something that's going to reduce your risk. So potentially you still have losses, but reduces the amount of risk. Then you need something that goes from big profit. Really get as maximum profit as possible, but then they also want some sort of strategy that's designed to not sort of leave any profit on the table. Okay, the four areas that we talked about before, these top areas up here. Keep something that exits that keep from giving too much away, and exits that maximize your profit, exits that produce loss but reduce your risk. When you think about it over time, it makes such a difference to my trading plan. I have a lot of 1, 2, 3 tick losses. If I was to always take 5 tick losses, then my average loser would be a lot bigger. And what I'm really focusing on is my average loser versus my average winner, and getting my average winners at least twice as big as my average losers, and that's what creates higher expectancy within your trading model. And then of course, having a maximum risk exit. So for myself, all exits are never any larger than 5 ticks. That's just non-negotiable. I always start with 5 ticks or less. Sometimes I'll start with a 3-4 tick if straight away there's a really good support resistance area. That means I can reduce my risk. Yeah, I'll do that straight up, but never larger than 5 ticks. Okay, 5 ticks is my 1R. Is my maximum risk. Okay, and then what I'm doing is all my winners I'm basing on 5 ticks. So and this is where you start to get into expectancy. Okay, so 5 ticks is my maximum risk. You know, anytime I take a 10 tick trade, well, that's a 2R trade. I'm making twice what I'm prepared to risk, and that's how I start to display all my results. And it's a really good way to understand or break down what's happening as far as profitability for myself. And then right down the bottom here, I've got all strategies. I reduce risk when a pivot is formed, where a stop can be placed 1 tick outside that designated holding area. Meaning, you know, where's an example of it today? Just to, you know, for example, you know, not that I traded here, but you know, if I was say buying in this area here, it's popped back. Say if I bought here, it's popped back 3 ticks. Okay, so I've got a negative 3 tick trade here, and then all of a sudden it starts really going in my favour. You know, it's created a significant little swing low point here. You know, if the market comes down and breaks this area, chance of it's going to keep on pushing through, which you can see it's done there. So I'm always looking for pivotal points or swing low, swing high areas. So for example, this is a real sort of level in the market. Once it starts going away from there, you know, if it comes back and breaks that area, I don't want to be in the trade anymore. So I want to reduce my risk by putting 1 ticker below that area. Okay, so that's a situation where you know, always reducing risk where there's a pivot or an area to be able to where it should be an area that holds, so a designated holding area, and if it breaks, then I want out. Okay, so that's a way of reducing risk, but still potentially taking losses. Okay, then as far as so that's as far as risk, I guess, taking losses as far as exits are concerned. As far as taking profits, exits where profit is gained, I've got 3 strategies. Okay, strategy 1, 2, 3. I market it as basically when I'm recording it, exit 1, exit 2, exit 3. And I'm basing on 3 different types of systematic areas. In regards to systematic, what I want to say, you know, in regards to having a systematic process of determining where trades go, which I'll get into a sec. You know, what this doesn't impact my entries. Okay, so I have an entry system, you know, but then this is completely separate, and I'm not letting it impact my exits. Or okay, so once I'm in a trade, so I'm looking for a potential entry. Okay, as soon as I get the entry, you know, that's done. Entry is finished. I'm then on to management of the trade. Okay, so that's where I switch straight away over to my exit strategy. And then from there I determine the potential of my trading area. And based on the strategies, whether it's an area I should act with some caution, whether it's an area of strategy 2's potential, or whether it's an area, you know, strategy 3 is massive potential. And as it's moving along, and I'll break it down as to how I determine these areas, but as it's moving along, you know, it's never just about predetermining something and leaving it. It is about evaluating the situation as I move along. So, you know, I might start off with a particular area, you know, caution or something like that, or potential. You know, if something changes within the market, I can then change my strategy as well. So most of the times I'm just sticking with one strategy, but I'm always evaluating as to what's happening as I move along. So as far as deciding how I decide on caution, potential, or massive potential, you know, I do this by using, again, it's a systematic process. I've got my 5-minute charts and my 15-minute charts. So on the 5-minute charts, I'll bring it up for a second. I've always got these key levels marked. Okay, so I start off with these key levels, and I get these from the 60-minute charts, some long-term charts, and they're predetermined at the start of the week. It's not like something I'm developing or creating each day. It's just start of the week, go back. You know, this is not a session about support and resistance, but basically I'm just using support and resistance, you know, over the last days and weeks and finding key levels in the market. Okay, so I've always got these marked, so that's one area I'm watching. And then the second area is the 15-minute chart, and on the 15-minute chart, I've always got key areas marked on the 15-minute chart. Okay, so whether it be a trend line, and if I go back to the markets, you know, there's always trend lines and all sorts here. I've got areas marked on there. This is for me, you know, the most significant areas in the market, which is trend lines or some of my most important key levels in the market where I just see the market just keep on reacting. Okay, again, it's not necessarily about me getting into exactly how I do this. You know, in my mind, it's very systematic, it's very exact, but I just want to give a bit of an overview or some ideas as to how I would approach it. Okay, then based on these, you know, key levels, trend lines, support and resistance areas, I'm deciding whether, based on that, whether it's got potential. Okay, so, and today I had all three exit strategies we use. So I want to go through today. Well, this is something that happened about a week ago, and go, had all three exit strategies triggered, and go through how I took the trade based on that particular area. So I'll do that now. Okay, so basically, again, keeping in mind, strategy one is where I act with caution. So I'll bring that up again, and just before I say, strategy one is act with caution. So that's where I'm running into, potentially what could be an area that's going to hold the trade up. So for that reason, and I've got a predetermined outcome as to what I do. So if it's a caution strategy, so meaning when I take the trade, straight away, as soon as I enter in, I go, okay, I'm applying exit one, I'm applying exit two, I'm applying exit three, and then I place my exit straight away. It's already predetermined. Like I said, I can change that based on stuff that's happening in the market, but most of the time I don't. It's just going with it. So if I get into a trade and it's exit number one, straight away I'm putting a exit target or a limit order at 5 ticks and getting some of my contracts out at 5 ticks. Usually a third of my contracts out at 5 ticks. What this does, and as soon as it does get to 5 ticks, then I'm reducing my stop loss to a 4 tick loss as well. But what this does, I'm in a situation where at most I'm going to lose 1 tick. If it was to go to get me out at 5 ticks and come back against me, get full stop out, all I do is lose 1 tick. So I'm in a situation where, because I'm acting with caution, I want to get to reduce my risk wherever possible, but I don't want to be dragging my stop loss up and all of a sudden reducing the possibility of the trade going with me in my favour. Okay, so I want to give it a chance. I want a chance to go, but I'm taking some contracts out early, and that for me is a way of reducing the risk. Okay, when I've got to act with caution. But like I said, strategy two is I don't want to be in a situation where I'm always taking some of my contracts out at 5 ticks. That's quite early. I want to be in situations where, on average, my winners are at least twice as big as my losers. Okay, for that reason, I don't want to be doing that all the time. This is sort of taking a combination of those influencing traders and finding how it works best for me. If I've got an area where it's got potential, I'm letting all the contracts go to 10 ticks. So that way I know I'm getting at least a 2 to 3 time or 2 to 3 R trade, meaning I'm making 2 to 3 times what I risk, because my risk is normally anywhere from 3 to 5 ticks, and I'm getting all my contracts out at 10 ticks. So they're big trades. And then strategy 3, massive potential. So this is where it's got a lot of room to move. I'm prepared to go for more, and I've got a predetermined. Oh, it's not a predetermined level. Sorry, of 10 ticks. I let it go to a target of based on support and resistance areas, or based on my 15-minute charts and key levels in the market, and that's where I'm letting all the contracts go. And this is big R trades. As far as what I do most of the time, strategy 2, I'd say more than half the time it's just strategy 2. And then I'd say the other half of the time, it's probably 25% is strategy 1, or maybe a little bit more, and then maybe not even a quarter, maybe 10%, 1 in 10 trades, or maybe a little bit more, I'm going for bigger trades. But more than 50% of the time, I'm just applying strategy 2. Okay, so a couple of examples of that. So here, I want to make a point that this trade here, I applied exit 2. It had potential. I got everything out at 10 ticks. So what happens is, basically it came up, popped off to support level. Okay, so if this goes, there's nothing holding it back from going to 10 ticks. There's more than enough room for it to go to 10 ticks. But it's not an area that I believed, based on looking at my 15-minute charts and a few different things. There's just potential to keep on going. Okay, so I'm applying strategy 2, where I get everything out at 10 ticks, which is what happened there. Strategy 2, next trade, reversal. So I'm looking for the mark. Once it popped down here, I was looking for a new trend to start forming here. So my entry signals here says, okay, it's a new direction's coming. It should start heading down. Okay, that's as far as the entry is concerned. I'm in. As soon as I'm in, I'm then straight away switching to my exit strategy. My exit strategy straight away says, okay, but you've got a fairly key level in the market here, which is about 5 ticks away. Just on a side note too, I'll never get into a trade if this level is only a couple of ticks away from the entry. My entry system says don't get in, so I wouldn't be in the first place, and that's to do with entry. Okay, but as long as it's got 5 ticks or more potential, you can see this one had exactly 5 ticks, I'm prepared to get in. Okay, so I'm in. If this line is 5, 6, 7 ticks away, a fairly key level in the market that it's been reacting to, then need to act with caution and reduce the risk wherever possible. So I want to give it the chance to go and break through this because it's got potential to break down, but I don't want to be sitting there with a full 5 tick risk. Okay, so as soon as it goes 5 ticks, which it got to here, I've got a third of my contracts out. This particular case is a good example. It then couldn't get through that area. It's popped back and would have stopped me out the rest of my contracts for whatever I determined. I might have had it 1 tick above there. I can't remember at the time, but it might have been 2, 3 tick stop out, at most 4 tick stop out. Okay, so some of my contracts are already out at 5 ticks, but so overall in these 6 situations where I apply caution and it goes against me, normally I'm getting anywhere from a -1 to a +1 tick trade. So I'm getting about break even. I apply caution, it doesn't go in my favor, I get some of my contracts out, I'm normally getting a break even trade. So for me, it's a great way to reduce the risk. We can see straight away it's easy for me to go, okay, let's apply exit 1 because there's a key level there that's holding the market up. Okay, the entry says it's going down, but the exit strategy says just be careful. Next area, strategy 3, where I'm going for big R. This particular one ended up being a break even, ended up being a loss. Okay, so exit strategy is there, but of course it's not always going to go to plan. But this particular one, even though it was a 5 tick trade, sorry, a 5 tick or a couple of tick loss, the trade I entered here, it went 3, 4, 5, 6 ticks. So it's a situation where I guess I could have got 5 ticks out, but the exit strategy said it didn't do that. It says enter here, and what I'm doing is I'm basing it on, again, the 15-minute chart. And if I bring up the 15-minute chart for a second, this is it here. This is roughly the area, and I'm basing on a few things. Basically, we bounced off this trend line. We came up, we bounced, we had a go. We've come back. This is about the 3rd or 4th time, and this time the markets, all the other markets were breaking, so I do use other markets as well. Just everything was adding up that it was going to potentially go and go up towards sort of these levels up here. So I start teaming my targets for up around here. Believe the area was going to go. So, there's nothing really holding it back. I believe I got support and resistance areas saying that this market can go and go quite a bit higher. So I'm prepared to go for a lot more. In this particular case, it went a bit, it really looked like it was ready to go. Starts breaking up through these areas here. When I do the probability on it or weigh up the odds, it's potentially an area it's going to go. Not all of them go, which is the example here. But I want to give myself a chance of getting big R trades. So this is an example of where I didn't need to act with caution, and I saw it as an area that had not only potential but massive potential. So that's an example of basically the 3 different exit strategies being applied. As far as a few more examples, right, here's another example. This is a directional trade that I took. So I'm getting in here, basically, all the other markets are starting to push up. So it came up, came down. It's making higher lows. It's really looking like it's starting a new trend. So I'm entering here. So my entry system got me in here. As soon as I entered in there, I go straight to the exit strategy. Okay, I see up here key level that potentially could hold the market down. You can see the market's come back off it and then went higher. Okay, so, and this is an example of where I changed the exit. Okay, so I gave it some, saying that it's got plenty of room, it should get at least 10 ticks, so that this particular line is 10 ticks away. So I said, okay, I'm prepared to go for exit 2, it's got potential. But then, after applying that exit, I realized that after it started sort of going there, didn't quite get there, and it popped back. What I'm saying to myself, if this comes back up and starts breaking this little pivot point here, usually what happens, and this is a good example of it, it keeps on going for at least a little bit. So I'm saying that, for me, there's no use in just having an exit right at that 1400 now that the market's done what it's done. If it's going to come back up here again and break, it's going to keep on going for a bit. So I switched to exit 3 and go massive potential. Set it for 1402. So the reason 1402 is because the line's not there real good, but the 1403 is the next level in the market, sort of the highs or near the highs. So most areas that I believe it goes to, I pick an area and come back 1 point, so give it a bit of room to get there. So 1402 was the exit on here. This particular one it just popped back 1 too many ticks. It's actually hit the break even exactly, which would have been here, and then it's went. But regardless of that, the exit strategy was applied. It was start off as potential, it's popped back, it's then created a situation where if it's going to go, it's going to really go. So I looked at the next level and gave it the ranking of massive potential and switched to exit 3. So hopefully, that makes sense. This is an example of, something that, for me, it's very systematic, it's very clearly defined. As far as deciding on whether it's cautious to be cautious, I mean the ones as far as being cautious, I think they're easy to understand even for someone looking from the outside in. As far as whether it has potential or massive potential, that takes a little bit more finesse on my behalf. I've got a few things, so I haven't gone into that in a lot of detail, but that's sort of not the importance today. I just really want to give an example of how to apply an exit strategy, create something just like an entry strategy. As soon as you get in, you want to be switching to your exit strategies. You want to have something that's simple. For me, it's very simple. It's very systematic. It's very easy to follow. When I'm recording all this information too, when I'm getting out of my trades, for example, I've got my, I'm sure you guys all do too as well, have a trading journal where you're recording all your results and what you do. So, when I'm recording, for example, here I'll say, directional trade, break even, exit 2 was applied, then switch to exit 3. But with all the trades I take on, I'm not only saying the entry, I'm saying the exits as well. So for everything I've got listed how I got in, so that entry, directional, reversal, continuation trade, whatever it is I choose, and then the exit strategy that was applied. So I'm really focusing in on the two parts of my system and my trading plan, and that what needs to be done to really start to create a habit of, because like I said right at the top of the session, it's if you do what professional traders do and sort of understand and you sort of give them the keys of what really needs to be done to create profit, become a profitable trader, successful traders, this is what they do. They spend more time, if not the same time, if not more time, on exits than entries. So for me, I need to do some changes and really make sure everything I do, if I'm talking about entries, I also need to talk about exits and really focus on that. Okay, so as far as the wrapping up the exit strategy, number one is I have a way of interpreting the market. Okay, for me that's key support and resistance areas on the 5-minute chart, or which are marked on the 5-minute chart, but they actually come from 15-minute and 60-minute charts, but they're key support and resistance areas. There's also trend lines there. But remember to do it your way, and there's many different ways to interpretate the market. But for me, I've got my very specific way of interpreting based on price action and key levels and trend lines is where I believe the market's going. And from that, then point 2 is I can then classify the trades into predetermined categories. Okay, so those predetermined categories, for me, there's 3 predetermined categories: caution, potential, massive potential. Okay, and then point 3 is I've applied the predetermined categories, and then each of those categories has a very specific way of approaching the trade. So I kind of outlined it here. Yep. So if it's strategy 1, caution, I've got a very specific way of how I get my contracts out. Some out early, then where the rest go. Strategy 2, what I do with the contract. Strategy 3, I've got to determine as to how I get the contracts out. So not only is it the predetermined categories, it's very, each exit strategy is very systematic in the way that I apply it and get my contracts out. So I'm not, as I'm getting into the trade, deciding, okay, here I might get some out here and some out there. It's not, it can't be like that. It's got to be systematic and everything sort of predetermined and to a business plan, so to speak. And for me, based on, and sort of back to what I said right at the start, is you've got to tie it in with your trading objectives. So remember, for me, it's about, I'm not a big risk taker. I want to reduce drawdown wherever possible. So by reducing drawdown, means I've got less of my account at risk. I'm not going to have situations where I lose 30, 40, 50% of my account. But that also means we're not going to have 200, 300% return in a year also. So reduce risk, reduce results. That works well with me. I'm fine with that. I don't want to draw down of, it's all built into my management plan. This is sort of a whole other area, but I don't want a maximum drawdown of more than 20%. But from that, I can then safely say I can go for 100, to potentially 150% within a year. But anything more than that, I'll have to start risking more. But that's what suits my trading objectives. But then at the same time too, within these trades, I don't want to, and Van Tharp, so this is where his sort of side influences me, is that you don't want to be in a situation where you just every single trade just focusing on sort of making sure you create profit every trade. If that's going to reduce your expectancy, that might sound funny, but point I'm trying to make is it's not always the best thing to sort of take your profit out as early as possible if you're leaving what could potentially be more profit there. And that's what I mean by, if I was to apply strategy one, yeah, I'd probably feel a lot better about myself. My strike rate would definitely increase because I'm reducing the risk and getting a lot more break even or one tick trades. But for that's all about reliability and strike rate. So that's increasing. But by doing that, am I reducing the expectancy of my trading system? I probably would be, because all of a sudden then I have to let my profits run a lot more further just to get some bigger multiple trades. So it's about having a balance. So that's why I've created something where it's reduces the risk, but I give myself the potential with strategy 2 and strategy 3 to really make sure I'm getting those big R trades. And that's, and it's very systematic. It's something that makes logical sense to me, and it's tied in with my trading objectives. So I hope you guys get something out of that, and we'll talk soon.